Hermes is an exceptional company. It was founded in 1837 in France by Thierry Hermes. Now, almost 200 years later, it still operates as a craftsman workshop. Hermes does not have any factories. Instead, they operate 52 separate workshops with a limited number of employees, just 250. All that to maintain a human scale and a community feeling of a workshop. Each product is handmade by just one person. To become an artisan and create bags and other products, you have to undergo a 4-year-long training program. Thanks to such a structure, they can expand globally but still maintain the craftsmanship and exceptional quality. This brand is luxury itself. Even the wealthiest and most influential people in the world sometimes have to wait months or even years to buy a specific Hermes bag. They are on top of the luxury pyramid. But let's see how this translates into financial results, and can we make money by buying a small piece of this exceptional company? If you were to invest $1,000 into Hermes 10 years ago, you could buy around 28 shares. And now they would be worth something close to $6,284. And this company also pays dividends, so in that time you would get $275 as dividends. So if we add together the current value of shares and the dividends, we get $6,559. And that is a gain of 556% in 10 years. A very nice result. However, it is important to keep in mind that past performance doesn't ensure future success. Individual insiders, that is a check. 67.6% of the company is owned by individual insiders, and around 66.7% of the company is controlled by the Hermes family, mainly through different holding companies. Hermes is structured in such a way that makes it almost impossible to take control of this company away from the Hermes family. Even Bernard Arnault, the wealthiest person in the world, tried to buy Hermes and failed. And are individual insiders buying? That is an X. We don't see any transactions from insiders in the last year. And the super investors own this company. That is also an X, but not because no super investors own Hermes, but because we just don't know if they own this company. And the reason for that is that it is a European company and super investors do not have to disclose such investments. So, of course, we also don't know if they are buying or selling this stock. Return on invested capital, that is a check at 24.9% 10-year median returns. And we want to see this number higher than 10%, so that is a nice beginning, and it only gets better. What do we know about net profit margin? It is a check averaging 25.7% over 5 years, and the industry median is only 5.9%. Hermes has the highest margin in the entire industry, and LVMH, which I analyzed recently, is second. And now let's take a look at share buyback. It is an X, but also a check, because the number of shares in the last 10 years almost did not change. And the debt? It is a check. Hermes basically does not have any debt. So all in all, they have a really healthy financial situation. revenue growth, that is a check at 11% 10-year compound annual growth rate. And we would like to see this number higher than 10%, so they just made it. And free cash flow growth, that is also a check at 17.1% in the last 10 years, so a very nice result. And earnings per share growth, that is a check at 15.8% in the last 10 years. So even though they are a company that was created almost 2 centuries ago and that produces handmade goods, they are still capable of growing significantly over 10% every year. That is impressive. The dividend yield is 1.1%, so shareholders can expect to get $2.48 annually per every share. And the payout ratio, that is a check at 46.2%. And we want to see the payout ratio somewhere between 20 and 50%. So that is very nice. We are getting a meaningful portion of the earnings through dividends, but they still have some cash left to grow the company. And what about dividend growth? It is a check at 8.7% 5-year growth rate. And this growth is not only stable, but it definitely accelerated in the recent years. So we know how strong this company is, and now it is time to value Hermes. But if you would like to get even more info about this company, or actually if you would like to get access to all the data about all the companies we analyzed on this channel and the ability to filter, sort, and compare all of them, then head over to our Patreon page and get our Stock Ranking or Stock Ranking Pro, which simplifies the process of finding great investment opportunities even further. Those rankings are tools that I initially created for myself. And now you have the opportunity to use those tools and get access to all the knowledge that I accumulated over more than 2 years of running this channel. If that sounds interesting, then the link to the Stock Ranking and Stock Ranking Pro is below in the description. Okay, so back to Hermes. Price to earnings ratio is 51.1. That is a lot. We have to pay over $51 for every dollar this company earns. That is high even for today's market prices. But to properly value Hermes, we will use a discounted cash flow formula and we will create 3 scenarios of its future growth. So, in the low scenario, we will estimate a growth of 6% for the first 5 years and then 5%, in the medium 8% and then 7%, and in the high scenario 12% and then 10% growth. So the low scenario is close to the predicted growth of the industry, which is around 5.7%. Medium is slightly higher than this prediction, and the high one is close to the results we saw in the last decade. So, with such estimates, the intrinsic value in the low scenario is $85, in the medium $96, and in the high scenario $122. But we have to also apply a margin of safety to those prices. The one I use is at 30%, but you can use any margin that makes you feel safe. And with such a margin, we get in the low scenario $59, in the medium $67, and in the high one $85. And the current price is around $228. So it is all in the red. Hermes is very expensive right now. Let's take a look at this company's overview. Straight away we can see that it is a very stable company. It is not only a growth company or only a dividend company, but rather all the metrics look nice. So it has best margins in the industry, incredibly strong brand, almost no debt, and a stable and strong growth. Unfortunately, the price right now is very high. I don't believe it is a case of a great company at a fair price, but rather a great company at an elevated price. So maybe this is one of those ideas that we should just put on hold. At a certain point in time, the price may come down and then we will be ready to act. Thank you so much for watching and see you in the next one.